So let's say you've made a decision. You're ready. You've listened to what we've shared in the last few sessions, particularly from the previous session. I talked about risk aversion. And let's say you have some clarity about your personality, some clarity on how you would react, some clarity on the level of risk aversion you possibly are willing to accept. The next question you might have, which is what we'll base today's session on, is should I be active or should I follow the passive approach to investing? In other words, do I choose my investment directly or do I delegate my investment to a process that does not require intellectual horsepower from myself, but is equally as good as achieving my investment goals? Let me define both strategies. Active investing simply means that you see yourself as what I would call an enterprising investor, and that simply means that you're willing to bring the time, bring the level of technical and intellectual expertise, and more importantly, you're willing to bring the level of psychology required to be an investor. To be an active investor, that it simply means you follow the definition of investing that I gave in the earlier sessions. I said that an investment operation was one upon which, following thorough analysis, promises safety of your principal and an adequate or satisfactory return. And I explained in that session that there were three very fundamental key components of the investment definition or the investment operations definition. The first was thorough analysis, simply means detailed analysis. The second was preservation of your principal, preservation of your capital, your seed capital. In other words, do not lose it. And the third was adequate return. To be an active investor, you have to recognize the skill set, the mindset, and the abilities needed for each of those three areas. In order for you to do thorough analysis, the first thing you have to understand is some appreciation and a very, very sound understanding of security analysis is important. Number two, you must have an understanding of accounting. I like to say, not just any elementary accounting. I would like to recommend detailed, fundamental, and even go beyond to forensic accounting. And the reason is very simple. The more you analyze companies, the more you recognize that there are so many ways in which companies can be quite, let me use the word, and let me be very careful about the choice of words. You become really surprised and aghast at how companies can choose not to be forthcoming in providing very candid information, and how they can be somewhat lacking in candor in how they represent and report information. To be able to understand that, you need to have some level of forensic accounting ability. You need to be able to look at an accounting statement or financial statement and identify what could be wrong. In other words, I like to use the reference of doctors who study the cadavers. And the purpose of studying a cadaver is to understand what went wrong, and then to take that knowledge and apply to people who are still alive, in recognizing how we can keep people healthy and keep people active and keep people well. So an understanding of how to analyze a company that has maybe gone bankrupt, a company that has been foreclosed, a company that has failed, and recognize what went wrong, those skill sets, you do not necessarily always get those skill sets in basic accounting. So I said you need security analysis as a skill set. You need to be able to understand accounting. And accounting is the language of business. If you imagine if you were going to travel to Germany and you were going to perhaps spend some time in Germany in a small city where they do not speak English. Now, predominantly, most parts of Germany speak English, but let's use this example of a small community where they do not speak English. They only speak Germany or German, considering that they are in Germany. One of the first things you must be able to do is communicate, to understand people, but also to be able to express yourself. Accounting is the language of business. It's how you understand how the business is doing. Now, the third skill set you need is finance, corporate finance. Very important. In corporate finance, you look at a business from the inside, understanding what levers are necessary to make the company successful. The next thing you need is you need an understanding of valuation, how to value a business. And in many ways, that can be acquired simply from osmosis, reading, studying, but also it can be done very formally by going to a corporate finance or valuation MBA course or undergraduate course. Now, finally, the last thing you need is psychology. The markets is made up of people making decisions. The decisions they make reflect in prices. Those prices vary over time. However, I use the example. I said that Richard Feynman, a physicist, once said that physics would have been much harder if electrons had feelings. And in other words, what he was trying to say is because electrons do not have feelings, if you switch on the light comes on. There isn't a rebellion by the electrons on whether they feel like or whether they do not feel too happy. They follow the natural laws of physics. Unfortunately, people are not robots. We are different. We have emotions, and emotions make up a very good part of why we're unique and why we are unlike any other life form. And that simply means that in a market full of people, you will have emotions. Let me give you an example. If you look at the average performance of, let's say, an index, a stock index in the UK, let's use the FTSE 250 or the FTSE 100. On average, the FTSE 250 in the last, say, 6 years, if you exclude the last 3 months, that has been slightly unprecedented as a result of this public health epidemic. If you exclude the last 3 months, the FTSE 250 has achieved an average rate of return of between 11.5% and 14%. Similarly, if you looked at the United States and you looked at the S&P 500, the S&P 500 in the same time frame, even if you extend up to 10 years, has achieved approximately 10% on average. Now, if you went into each and every single year, rather than the average, using the S&P 500 for example, if you went into 2008, 2009, 2010 and asked yourself, what did the market achieve? What did the S&P index achieve? Or what did the FTSE 250 or the FTSE 100 achieve in each and every single year? You come to the very, very interesting realization that the S&P, although it's achieved 10% on average, it has never achieved 10% every single year. Some years you achieve 20, some years you achieve a negative return, maybe minus 15, minus 12. Some years you achieve 30%, but when you take the average, it gives you approximately 10%. Likewise, in the FTSE 250, some years you achieve 1%, some other years you achieve 25, some other years you achieve negative 2, but you take the average and it gives you between 11 and 14%. Now, here's the question. How can the average be 10% and individually each year it's different? The reason is simply because of the involvement of people. Now, every economy, the UK might grow at a rate of say 1.8%. So I want you to think about this. The economy grows at roughly 1.8%. When you look at companies on average, they might grow at roughly 6 or 7, 8% at the most, on average. However, the index, the performance on average in the UK for a FTSE 250 index is roughly between 11, 12, up to 14%. Now, why is that disparity? And the reason is simple. The economy goes slowly, 2%. The company does 5, 6, 7%, but the stock does this every year. And the reason for that gyration is simply because of the involvement of people. People get very optimistic and they get very pessimistic. And so their optimism and pessimism represented or reflected as emotions are manifested in the results that the average investor would obtain. Let me go back to what I was trying to explain before I deviated and got distracted. To be an active investor, you need a skill set. I just explained 5 different skill sets you need. Security analysis, accounting, corporate finance. I said you have to have an understanding about valuations. And most importantly, you have to understand psychology or behavioral psychology, understanding emotions and how to control your emotions. That's the first part. The skill sets are the first 4. The 5th is the mindset, meaning how to think like an investor. The attitude you should have towards the market. It's a funny thing to remember. Most people are guided by the market. You look at a stock price and that tells you how you should feel. The important thing to recognize is that if you want to be an active investor, it simply means that you must divorce yourself from the opinions of other people. If you have the skill set and you have the mindset to be able to analyze and choose the right assets, then technically you do not need the opinions of others. I'll say something that I think is very, very, very important. Benjamin Graham said, "You are neither right because the market agrees with you, and you are neither wrong because the market agrees or disagrees with you. You are right because your facts and your reasonings are right." In other words, you've done your analysis, you've done your due diligence, you've come up with a conclusion, and you're secure in yourself simply because you have the ability and you have what I might consider an advanced level of thinking compared to everyone else. So you're right because your facts demonstrated by numerical evidence or quantitative evidence or qualitative evidence. That's what makes you right. Your facts are right and your reasoning, meaning your thinking, is right. Anyone who has all of those attributes has the ability to become an active investor. The second thing you need is time. So you have the ability, skill set, mindset. The second thing you need is time. It requires a lot of time. I'll give you an example in myself. I spend every day approximately 10 hours reading annual reports, industry publications, because you become more of a researcher and you just keep reading and reading and reading, because what you're doing, you're trying to find an opportunity. I'll give you a good example. In the UK, we have approximately about 1,600 publicly listed companies. So for you to be an active investor in the UK, investing in publicly listed stocks, you have to read 1,600 annual reports. In every year, one annual report is produced. However, the company also produces 4 quarterly reports. Therefore, you can't read one report once a year for one company. You have to read one report, which is the annual report, 4 reports, which are the quarterly reports, and all the additional information being provided by the company. You have to study all of its competitors, which is very, very, very time consuming. It's partially the reason why Warren Buffett says that he spends 80% of his time reading, and it's simply because there's so much to absorb. Plus, you're trying to find a good opportunity. If you choose an asset class that is not confined to stocks or companies, then it means you also have to be doing additional analysis with properties, whether commercial or residential. And so you observe very quickly that time is usually, in my opinion, the most challenging part of an active investor's path or choice of career. And the reason is because not everyone has the time. If you do it fundamentally how it should be done, it's time consuming. There are software packages that can extract the quantitative information from these reports to make life easy for you. However, the qualitative still requires the active investor's time. That is active investing. In order to do active investing, you must have the time, you must have a passion for what you do, you must have the skill set. I'll say something else. You must also have the psychology to deal with the vicissitudes that occur from investing. I'll give you a good example. If you're not willing to act with equanimity to a decline of 10%, 30, 40, 50 in your investment career, then you should not be an active investor. I'll say that again. If you're not willing to act with equanimity to a decline of 20, 30, 40, 50% over a long period, say, in a 20-year investment career or time horizon, then you're not fit to be an active investor, simply because emotionally you're not resilient. Now, let's move to the second type of investment choice you can make. You can choose, or you might decide, as a result of what you've heard me explain, you might decide, I don't have the time. I have a full-time job. I have hobbies. I have a family. I have other commitments. I cannot spend 8 hours studying. I cannot spend 6. I cannot spend 4. I cannot spend 2 every day learning. In addition to that, I don't have the skill set. I don't have the mindset in order for me to be an active investor. But I still want to achieve my investment objectives. There's a way to achieve that, and that is through what's called passive investing. Let me explain passive investing in a simple way. I'd like you to imagine that we are sat in a hall, and that hall is completely filled with 100 people. 50 people to the left and 50 people to the right. On the left are the group that I just explained in the last few minutes, active investors. On the right, we'll call those passive investors. Now, before we group them, let's start by saying that on average, all of these people would achieve 10% as a return. On average, everyone has to achieve the average. However, the people who are active investors, because they're buying and selling and actively making decisions They invest their time, which would mean that there will be a fee for their time. There would also be a fee for their transactions, and there will be fees for taxes they have to pay. And there could be fees for any other management expenses that they would incur as a result of managing a portfolio. So although they achieve 10%, overall, they might expend 2.5% on fees, which would mean the net return that they achieve is 10% less 2.5%, which is roughly 7.5%. The group to the right, we give them the task where we say, we do not want you to trade, we do not want you to buy and sell. In other words, you're going to be passive. We're going to allow you to allocate the funds you have to all the companies in the UK. I talked about 1,600 companies, approximately. We call that the FTSE all shares. You might decide, on the other hand, I want to limit my investment to the top 100. We call that the FTSE 100. You might decide, okay, well, I don't want the top 100. I want the bottom 250. We call that the FTSE 250. The group on the right decide, we'll simply allocate our funds to those companies. We will not participate in the buying and the selling, the analyzing and the selling, selection, and for that reason, they achieve the average, 10%. The group on the right, on the left, achieve 7.5% net. However, the group on the right, because they haven't engaged in the level of sophisticated work as the group on the left, their expenses will be much less. It wouldn't be 2.5%. Most index funds will allow you to invest with them for a fee, a total fee in the region of 0.8%. Some even go a little bit lower. So on the right, you pay 0.8%. The group on the left, as a result of all of their activity, have to pay 2.5%. Now, what does that mean? It means net, the group on the left achieves 7.5% return. You, on the other hand, on the right, you achieve 10% less 0.8%, which means you achieve 9.2%. So you outperform the group on the right. That's simply passive investment. So passive investing is simply deciding that you do not have the ability. And there's nothing wrong with that. You could be a doctor, you could be a surgeon, you could be an accountant, you could be a stay-at-home mom, a role that I think is hugely underrated and underestimated. You could be a stay-at-home dad, you could be a dental nurse, who knows, you can do whatever you want. You can even be someone who just doesn't want to work. You could be a student. But you've decided, I do not have the time to invest. Therefore, I will simply select all of the companies, and that's all I have to do. And I will meet or match what's called the average. And statistically, over time, most index funds outperform actively managed funds. It sounds really bizarre. You go through all that labor to manage a portfolio, and you underperform someone who puts all of their money in an index, primarily because of the costs of trading, taxes, management, transactions, etc. The point is, most people are better off choosing to be passive investors. Unfortunately, most people do not choose to be passive investors because there is no excitement. It's somewhat boring. You know, you select an index and you just put money there and you sit back and wait. Unfortunately, people miss out on the rush, the adrenaline and dopamine release and hit that they get by buying and selling or by buying. In other words, most people are addicted to their decision-making processes that become successful. You find a stock, it's selling at £10, you buy it, it goes to 20. and suddenly you believe you're a genius. You buy more. It goes to 22, you think, whoa, I must be really good at this. That gives you a dopamine hit, a release, makes you feel special, makes you have a feeling of importance and accomplishment. That only comes if you do things actively. It does not come by doing a passive or following a passive strategy. So, what should you choose? Which path should you choose? I believe if you've listened to everything that I've shared from the first session up until this session, you should know yourself a little bit better. You should recognize that there is no shame in choosing to be passive. As a matter of fact, you are much more likely to do better than the people who manage actively. Let me give you a classic example of a real life experiment, and you can find this information on YouTube. I believe it was in 2009 or 2010. Warren Buffett, who is considered to be the greatest investor of our generation, decided to take up a challenge. He explained exactly what I've just explained to you. He said, the average person would do better if they have an index passively invested than giving their money to someone to manage it actively, because the average active manager does poorly and does less well than the passive fund. So he had a wager of £1 million, and he said to a few hedge funds, I don't care who you are, I'm going to bet that in a 10-year period, you cannot outperform an index fund. And so someone took up the challenge. Someone in a firm called Protégé Partners. It's a fund of funds. Their role was to select 5 different exceptional fund managers, and every year they would try to outperform the index. And at the end of the 10-year period, both parties, Warren Buffett and this fund of funds called Protégé Partners, will look at the results. It's fascinating. There is a website called longbets.org. It contains the wager, but also on YouTube you can find the result of this wager. By a very, very, very large margin, the actively managed fund, I don't have to put this, they underperformed, not by a small margin, by an incredibly huge margin. They underperformed the index. So history shows that a passively managed fund will underperform, will overperform an actively managed fund, especially, and here's the caveat, especially during what's called the bull market, during a growth period. However, I'm not suggesting that there are no active managers that do better than passive indexes. Of course there are. But those managers are managers, number one, who are long-term. So they don't buy and sell and buy and sell and buy and sell. They simply buy and then they hold. Because the key issue with active management is the transaction cost. Every time you buy and sell, there's a transaction cost, but also there are taxes you pay. Plus, you have people doing the buying and selling, so you have to pay them also. There are actively managed funds or active managers that outperform the index funds, but they're very few. They're usually people who are long-term, have a very, 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 very clear philosophy, principle about investing, have limited themselves to a particular niche in the market. And for that reason, because they're unique people, very clever, very intelligent, very talented, they're able to outperform the index. Now, the key thing is, in a down market like we're experiencing today, the passive fund will underperform a good active manager. And the reason is simply because the active manager can make decisions, or he can bet against the market. Passive accounts simply bet with the market. An active manager can be what you might call someone who places hedges, meaning sometimes you can bet against the market. You can allocate your portfolio in such a way that if this part does well and this part doesn't do too well, when you bring both together, you're doing quite well. That simply means you can place strategic allocations of funds. You can design a portfolio that is somewhat engineered to suit the climate and the psychology, which unfortunately the passive portfolio is unable to do. Now, that's all I'm going to talk about in today's session. I'll leave you with a question and a concluding statement. You're neither right nor wrong because the market agrees with you. You're right because your facts and your reasonings are right. That is for active investing. Now, for passive investing, I would say this. You're much more likely to outperform the active manager, but you must be disciplined. You must learn to invest for the long term and let your investment apply the compounding process and grow. So it's up to you to choose which approach to follow. I've made my choice. I like the game. I enjoy the game, so I've chosen active investing. That doesn't mean that I'm guaranteed to outperform all passive investors. It just simply means it's something I have a passion for, and I believe that I can outperform the passive funds. You can choose to be a passive investor, or you can choose to be an active investor. The most important thing is recognize and understand yourself. Understand what makes you yourself, not what makes you someone else. Remember this, the key is to achieve your objectives. I like to think of achieving your investment dreams like the center of town. There are many roads that can get you there. Active investment is one, passive investment is another one. You can use any path you want, but before you do, think what works for you and what wouldn't work.